Two identical portfolios often produce completely opposite financial destinies. While most people focus exclusively on the average annual return of their investments, the hidden reality is that the order of those returns matters far more than the final percentage. This phenomenon, known as the sequence of returns risk, is the primary reason why two individuals with the same million-dollar balance can end up with vastly different outcomes. Understanding how timing dictates wealth preservation is the difference between a comfortable 30-year retirement and running out of capital in less than a decade. The data reveals that the most dangerous period for any portfolio isn't the duration of the journey, but the specific moment the withdrawals begin. In the world of wealth management, the term average return is often a mathematical illusion that masks deep-seated risks. If a portfolio gains 20% in year one and loses 20% in year two, the average return is zero, but the actual account balance has declined by 4%. This gap between arithmetic and reality is where sequence risk begins. Consider two hypothetical investors, each starting with $1 million and an average annual return of 7%. Investor A experiences a bull market in the first 5 years of retirement, while Investor B faces a significant market downturn during those same initial years. Although their long-term averages might eventually align, their ending balances will look nothing alike. When a market decline occurs early in the withdrawal phase, an investor is forced to sell more shares to meet their income needs. Selling assets at depressed prices effectively locks in losses and reduces the remaining capital that can benefit from a future recovery. It is a mathematical feedback loop that is difficult to escape once it gains momentum. Conversely, a positive sequence in the early years provides a buffer that can sustain a portfolio through later volatility. If the initial $1 million balance grows to $1.5 million before a downer hits, the impact of withdrawals is significantly dampened. The early years act as a structural foundation for the decades that follow. Historical analysis of the S&P 500 shows that the variance between a lucky start and an unlucky start can result in a difference of millions of dollars in final net worth. But the data tells an even more concerning story for those who ignore the red zone of retirement timing. Economists define the fragility zone as the 5 years immediately preceding and following the date of retirement. During this 10-year window, a portfolio is at its highest level of vulnerability because the account balance is typically at its peak while the time horizon for recovery is shrinking. A 30% market correction when an individual is 40 years old is a buying opportunity. That same correction at age 65 can be a permanent wealth-destroying event. Without a steady paycheck to offset losses, the portfolio must function as both the engine of growth and the source of survival. The psychological weight of seeing a balance drop from $1.2 million to $800,000, while simultaneously withdrawing $50,000 for living expenses, often leads to emotional decision-making. This pressure frequently causes investors to abandon their strategy at the exact moment they should be disciplined. Mathematics shows that if a portfolio loses 25% in the first year of retirement, it requires a 33% gain just to get back to the starting point, not including the funds withdrawn for expenses. The erosion of capital during the fragility zone creates a hurdle that many portfolios never overcome. This fragility is compounded by the fact that many retired households utilize a static withdrawal approach, which often fails to account for the changing tides of market cycles. This leads to what professionals call the failure of the fixed withdrawal trap. For decades, the 4% rule was considered the gold standard of retirement planning, suggesting that one could safely withdraw that amount annually, adjusted for inflation. However, this rule was built on historical averages that do not always reflect the extreme volatility of modern global markets. In a negative sequence of returns, a fixed dollar withdrawal becomes a larger and larger percentage of the remaining balance. If a portfolio drops by 20%, a 4% withdrawal effectively becomes a 5% drain on the remaining assets. This accelerating depletion rate is the silent killer of long-term wealth. Data from the Great Depression and the 1970s stagflation era shows that rigid withdrawal strategies were the primary cause of portfolio exhaustion. Those who maintained high spending levels while the market was in a secular bear trend saw their success probabilities drop from 90% to less than 30% in a matter of years. Inflation adds a second layer of complexity to this risk. If the cost of living rises by 6% while the market is down 10%, The real-world impact on the portfolio is a 16% loss of purchasing power. The sequence of inflation returns is nearly as critical as the sequence of market returns. But the solution isn't to avoid the market entirely, as that introduces the risk of outliving one's money through lack of growth. Instead, sophisticated investors utilize specific defense measures to shield themselves from the sequence of returns risk. One common strategy for mitigating sequence risk is the bucket strategy, which segments assets based on when they will be needed. By keeping 2 to 3 years of living expenses in cash or liquid cash equivalents, an investor can avoid selling equities during a market downturn. This cash buffer provides the psychological and financial breathing room for the stock market to recover. When the market is up, the investor replenishes the cash bucket. When the market is down, they spend from the cash and leave the equity portion of the portfolio untouched to rebound. Another powerful tool is the implementation of dynamic spending guardrails. Instead of a fixed withdrawal, the household adjusts its spending based on the portfolio's performance. In years where the sequence is negative, the withdrawal is reduced slightly, preserving the core capital for better days ahead. Diversification into non-correlated assets, such as high-quality bonds, real estate, or treasury inflation-protected securities, can also dampen the volatility of the sequence. The goal is not just to maximize the peak of the mountain, but to ensure the descent is controlled and sustainable. Modern financial planning software now uses Monte Carlo simulations to test thousands of potential return sequences. This allows for a deeper understanding of how a portfolio might behave in the worst-case scenarios, moving beyond the simplistic and dangerous reliance on historical averages. The most important insight to remember is that wealth is not just about the total return earned, but the timing of when that wealth is accessed and preserved. If this changed how you think about retirement planning, the next video breaks down the most effective sustainable withdrawal strategies for modern markets.